Hey guys, so I decided to record this and should be easier than typing all the steps out, so you can just go ahead and follow along while I do it. Mind you, I'm not an accountant. If I don't explain it the best, I'm sorry. I'm just trying to explain how I understand the numbers and how I find the answers. So I hope that maybe you'll get something out of this. And then I'll also link there'll be a step-by-step guide that like color correlates, so you can open that and follow along as well as I'm going through this, or you can just follow along on your own page too. So we'll start by just the natural flow of an income statement is you go down all the revenues, all the cost of goods sold, then you hop over here to the cash flows, go down there, hop over to the top of the balance sheet. Just a sideways zigzag is the natural flow of the numbers, okay? So all of these numbers right here for the income statement are all going to be the same from the weeks past. So I'm not really going to go over all of these, but I will go over the cash flows and the balance sheets and the break evens and stuff from last week as well. So we'll start right here in our first month cash flow. So this is the 12-year, or not the 12-year, the 12-month full quarter sheet or whatever he called it. So we'll start here. So we don't have to pay our cost of goods sold until the next month, which is stated right here. All costs are paid the next month they're produced. So we have our cost of goods sold of $60,000 for $100,000 of revenue. So it takes $60,000 just in direct materials, direct labor, and machinery rent to produce those products, which end up to come out to $100,000 in revenue. So we put a zero there because we're not paying that until next month. So we'll go down here, our salary, our advertising, all of our operating expenses are going to be the same, whether we sell a product or not. So we have to pay $18,500. So that is a consistent across the board. So you have to pay that regardless if you have revenues. So we're going to pay that $18,500. So add those together. We're going to subtract all of those from our initial cash, which is $75,000. Actually, we'll subtract it from our total assets because that's where we'll subtract it from the next month. So our total assets are basically all of our cash right here that we have on hand and all of our accounts receivable. That's our total assets. So that's the money that we have to be able to pay our expenses. So we take $75,000 minus $18,500 because that is all of this added up. So we subtract $18,500 from $75,000 and we get our cash balance on the balance sheet of $56,500. So that's how much cash you have left after you've subtracted all your expenses, okay? Or all of your operating expenses that you have to pay this month because we didn't subtract your cost of goods sold until next month, okay? So we've got $56,500 left in cash, all right? Our accounts receivable are $100,000 because we have an account receivable right here that we're going to receive for our products that we sold of $100,000 in revenue. So you just record that right there, correlates with that. You go over to your total assets. So your total assets are your cash and your accounts receivable added together. So it's this plus this equals this, okay? That is all the money that you have to be able to pay for your expenses, okay? That's your total assets, that's the positive, that's all good, okay? You go down to your accounts payable. Now, what do we have to pay until next month? We still have our $60,000 that we have to pay next month. So we just put a negative there. You can put it in parentheses, whichever one you want, to record it. That's not subtracting it from anything, but you just need to record it as an account payable because you're liable for that $60,000 that you have to pay next month because obviously you accumulated that in the first month. Okay, so just record that there in your accounts payable. Actually, we can put it in line right here with accounts payable so that you can see right there, accounts payable. All right. We move down to our owner's capital. Our owner's capital is always going to be $75,000 because that's what they initially invested into it. So owner's capital is always going to be $75,000 because that's what we started with and that's what they invested. Your retained earnings is going to be obviously your profit at the end of this. So that's your revenues minus your cost of goods sold minus your expenses. That's going to be your profit. So that's what you retain. That's the earnings that you retain. So you're going to put those right there in the retained earnings. You add those two together to get your total owner's equity, okay? So that's obviously his initial investment, $75,000, plus his retained earnings of his profit, which is 29,500, and you get your 96,500. Okay. Now we're going to move over to our next income statement, our second month. Okay, those are from last week. Our cash flow. So we record our $100,000 from our last month right there. I'm not really sure actually why I do that, but that's just what he said. Just record it in that first block. You're going to move down. So out of this, our total assets right here, because this is what we're going to have to pay for our expenses, because we used our total assets over here to pay for our expenses. So now you grab these total assets, which is your cash and your accounts receivable. That's what you have to pay your expenses with. Take 156,500 minus all of these expenses, okay? Because that's what the cash that you have available now to pay your expenses. So 156,500 minus your 60,000 that you had to pay from last month, because it's accounts payable. You subtract that now. We don't subtract this 110,000 until next month. So subtract 60,000, subtract your 18,500, which your operating expenses is always going to be the same. And you're going to end up with $78,000 left over. Okay. So that was 156,500 minus 60,000 from last month, minus your 18,500 operating expenses from this month. Okay. That's where you get your 68,000. Our pre-tax profit's going to be 51,500. You're going to go up here to your accounts receivable. So that's what we have to receive from the company that is buying a product. Okay. So that's going to be $180,000. That's your revenues for this month. So that's an account receivable because you're going to receive that. Don't know when, but you'll receive it. Now our total assets, remember, is our cash plus our accounts receivable. So you add these two together, 78,000 plus 180,000, and you come out with 258,000. Okay, that's your total assets, and that's what you'll use to pay your expenses next month. Okay, you record your accounts payable right here because you don't have to pay this $110,000 cost of goods sold until next month. So you record it right here. Your owner's capital is always going to be $75,000 because that's what he initially invested. Your retained earnings. So that's going to be the earnings that you have retained throughout all of this. So it's your profit plus your profit for the second month. So your profit plus the first month plus your profit from the second month to get all of your retained earnings, which is going to equal out to $73,000. Your total owner's equity is going to be this plus this equals that. Let me make sure that's right. I don't think that's right. 75,000 plus 73,000. So this is actually 148,000. Sorry. My number's wrong. So your total owner's equity is going to be your owner's capital plus the retained earnings, and you get $148,000. All right. We move on to our third month. All of these are going to stay the same. We go up to our cash flows. We record our accounts receivable from last month, which is $180,000. You record that right here in your cash flow. Okay. Now, do you remember what I said? Your total assets, which is gonna pay for your expenses. Okay, so we go up to our last month's total assets, which is right here, which is what you have available from your cash and your accounts receivable. That's what you have to pay for your expenses. So you take $258,000 minus your $110,000 from last month in your accounts payable, because you have to pay it this month. $258,000 minus $110,000 minus your constant operating expenses of $18,500, and you come out with $129,500 for your cash, which goes right here. That's how much cash you have left over after subtracting all of your expenses from your total assets from the month before. Cool. All right, our accounts receivable, $240,000, because that's your revenue. That's what you have to receive. Right here, your total assets are your cash plus your accounts receivable to get $369,500. Your accounts payable, we'll just move this up here just for shits and giggles. $175,000. So that's your cost of goods sold that you don't have to pay until the fourth month, but you just recorded in your balance sheet. because you have to pay that. All right, we move down to our owner's capital, always $75,000. Our retained earnings, all of the earnings that we've retained. So you add all of your profits together, 21,500 plus 51,500 plus 46,500. Yep. And come out with $119,500 as your retained earnings. You add those together to get your total owner's equity of $194,500. Okay. Let's go over to our first quarter cumulative. So for our cash, we're gonna have, or wait, I'm sorry. This is not gonna be cash. This is gonna be your revenues. So this right here, this column is gonna correlate with these values, not these, okay? So this correlates with each one of these words. So your cumulative means you add it all together for your first quarter for the first 3 months. So you add up all your revenues, 240,000 plus 100,000 plus 180,000. You come out with $520,000 cumulative revenue, okay? Direct materials, add up all your direct materials right here, right here. You're going to come out with 140,000. Direct labor, add all of those up. Your machinery lease, add all of those up. Your accounts or your cost of goods sold, you add all of those up. So this is going to be 60,000 plus 110,000 plus 175,000 equals 345,000 cost of goods sold. Your salary is going to be $10,000 each month. You multiply that by 3, you get $30,000 because all of these are staying constant. Okay, they're going to be the same price. They're going to be the same expense every single month. $3,000 times 3, 9,000, 4,500 times 3, 13,500. Insurance times, or $1,000 times 3, $3,000. Okay. Operating expenses, that's all of that together. So 18,500 times 3, $55,500 as a total operating expense for all 3 months. Okay, cumulative. Your net pre-tax profit is going to be, let me see, actually, I'm not sure. Yes, that actually be correct. Yep. So your pre-tax profit is going to be your retained earnings right here, because this is your retained earnings because we've added up our profits for the past 3 months, right? So you just add up 46,500, 21,500, and 51,500, and we get a total of 119,500, which equals our retained earnings right over here. Okay, so that's cumulative. That's for the first quarter. Okay, so here we'll start on the second quarter. So starting on our second quarter, or on our 4th month, all of these values in the income statement, all of this value right here in this column, and all of the values in this column is going to be the exact same, because whenever we scroll up here, 3rd month of operations, 50,000 units sold at $6 per unit for the rest of the year. So they're getting the same amount of revenue after the 3rd month. So all of these values right here in the 4th month, all these values in this column and in this column are going to stay the exact same. Okay. So we'll go ahead and go through there. Those values are from last month. You put your $240,000 revenue, or your $240,000 from last month, because that's what we got last month. You put that right there in your cash flow, top column or top block of your cash flow. Scroll down here to your cost of goods sold. This $175,000 is from last month. So I'm going to put an L in. I'm going to put a, let me see. I'll just put an L in. That makes it clear. I'll just say that's last month. So $175,000 is from last month because we have to pay this next upcoming month. Okay, so we're going to pay that right there. So does anybody remember where we, the account that we pay all of our expenses out of? We scroll back out over here. It's our total assets account. Okay, our total assets is our cash and our accounts receivable that we have available to us to pay our expenses. So you're going to use this value in your total assets block to pay off your expenses. So you're going to take $369,500 minus your $175,000 cost of goods sold from last month, minus your operating expenses of $18,500, which comes out to $176,000 in available cash now that you have subtracted your expenses from it. Okay. You take your accounts receivable, which is your $240,000 right here in this revenues. Put that right there because you're going to receive that. Move down to your total assets. Remember, total assets are our cash plus our accounts receivables. That equals out to $416,000. We record this month's cost of goods sold right here in our accounts payable tab, because that's the account that we have to pay, that we're liable to pay next month. So we record it right there as a negative. Owner's capital always going to be $75,000. Your retained earnings, okay, for our fourth month. So you're going to add up this month's profit, last month's profit, the month before that, and the month before that. So you add all of those up to get your retained earnings right here of $166,000. What you could do simpler is just scroll up to your third month, because your third month's retained earnings contains the past 3 months added together. So just to take $119,500 plus this month's profit, which is $46,500, and you'll come out with $166,000. And we add that together. We add our retained earnings plus our owner's capital and get our total owner's equity of $241,000. Okay. Move to our fifth month. All of the values are going to stay the same, but instead we're going to take last month, so the fourth month, since we're on the fifth month. Now we're going to take the fourth month's total assets, which is right here. Okay, $416,000 minus our $175,000 from last month. So that's where we take this value. We're paying off this value now in the fifth month, $416,000 minus $175,000 minus our operating expenses, $18,500. You come out with an available cash balance of $222,500. Okay. We put this $240,000 from our accounts receivable over here in the last month. You put that in the first block of the cash flow. You go through that way, hop over there. Our available cash, $222,500. Our accounts receivable, okay, scroll over here, correlates with that one. $240,000 is going to be our account that we're going to receive for this month as our revenues. Put that right there. Our total assets, remember, what do we add together? Our cash, accounts receivable, add those two together, get $462,500. Okay, so that's where we're going to use next month to subtract all of our expenses from. Okay, our accounts payable, we've got to pay our cost of goods sold next month, so record it right here in our accounts payable as a negative. Owner's capital, $75,000. Retained earnings, add your retained earnings from last month plus your new profit for this month to get your retained earnings for the fifth month, $212,500. Add those two together, you get your total owner's equity of $287,500. Okay. 6 month, all the values are going to stay the same again. Put your $240,000 from last month. We've got that there. You put it in the first block of your cash flow. Cost of goods sold, we've got to pay our $175,000 from last month. So we pay that off here. What do we use to pay this off, to pay our expenses off? We use our total assets from last month, $462,500 from last month. Subtract our $175,000 from last month as well. Then subtract our operating expenses for this month, $18,500. You're going to come out with $269,000. As you can see, it's increasing every single time because we don't have to pay our cost of goods sold until after we get paid with our accounts receivable. That's why we're able to increase our cash flow. Go down here, $240,000 as our accounts receivable for this month, because that's our revenues. Your total assets, add your cash plus your accounts receivable to get your total assets. We'll use this number next month to pay off our expenses. Your accounts payable for this month, because we didn't pay our $175,000 from this month, record it there as a negative. Owner's capital, $75,000. Your earnings that you've retained, you're going to add go up here, You're going to add your $212,500 from last month, your retained earnings right here. Add $212,500 plus your new profit for this month, $46,500 to get your total retained earnings of $259,000. Add your owner's capital plus your retained earnings, total owner's equity of $334,000. I left the second quarter cumulative blank because we'll do that together because I haven't got that far yet. So our second quarter cumulative, so we're gonna add all of our revenues from our fourth, fifth, and sixth month together. So since they're all the same values, 240,000 times 3, because all of our values are the exact same, 240,000 times 3, $720,000. All right, our next is our direct materials. All of them are going to be $80,000 because they're all the same values. $80,000 times 3. All right. $240,000. Direct labor, $240,000 because it's $80,000 times 3 again. Machinery rent, $15,000 times 3. It's going to be $45,000. Our cost of goods sold is going to be $175,000 for all 3 months because they're the same value. $175,000 times 3, $525,000. Salary is always going to be 10,000, so 10,000 times 3, 30,000. 3,000 right here. Advertising times 3 is going to be $9,000. $4,500 times 3 for advertising, or for office rental should be 13,500. Insurance, $1,000 times 3. $3,000. Our operating expenses, $18,500 for all 3 months. You multiply that times 3. You're gonna come out with $55,000, $55,500. Okay. And then you're gonna come down here and calculate your net pre-tax profit for all 3 months for the second quarter, 4th month, 5th month, and 6th month. All of them are going to be the exact same profit because that's their exact same revenues, all of our other values. So $46,500 times 3, $139,500. Yep. Okay. So that is our second quarter cumulative. That's how I got all of these. And like I said, these values correlate with these words right here. So our cumulative for those. Move on down to our third quarter. I'm going to fill in all of our income statements values right here in these columns because they're going to be the exact same from the previous ones. So I'll stop that and that. Okay, so here we'll start on our third quarter. I didn't know this, but you can actually put your last month's balance sheet. So this balance sheet right here, which contains all of our values to use for this month, you can actually put that right there. So I put that right there so we don't have to scroll up and down every time. So this is last month's balance sheet because we're going to have to use our total assets to subtract our expenses from. So go through the revenues, your income statements and values, all the same. Our cash flows are all going to be the same as well. You put your $240,000 there from last month, which is your accounts receivable from last month. You put that right there. You're going to go down to your cost of goods sold that we had an accounts payable for last month because we have to pay our cost of goods sold for last month, this month. So you're going to use your total assets, remember, because that's your cash and your accounts receivable. You can kind of classify your total assets as your bank account. So it's got your, basically all your accounts that you've earned money on and your available cash that you've got. Consider your total assets, your bank account. So to subtract expenses, you're going to use your total bank account, which is total assets. So $509,000 minus cost of goods sold for last month, $175,000, minus your operating expenses for this month. And you are going to get, let me do the math, sorry. Minus 175 minus 18. So you're gonna get with an available cash balance of $315,500. So that's how much cash you've got in your bank account. You've got your accounts receivable from this month, which is $240,000 coming in as revenue. You add your cash plus your accounts receivable to get your total assets. So $315,500 plus $240,000 revenue. You're going to come out with $555,500. Okay. These are your total assets, and this is what you're going to use to pay off your expenses next month. Okay. You put here in your accounts payable. You've got, your accounts payable of this month, your $175,000 cost of goods sold. Record that in your balance sheet. Come on down to your owner's capital, which is always going to be $75,000 because that's what they initially invested in. And all of your retained earnings. So $259,000 is all of your retained earnings up until this month. Okay. So just do $259,000 plus your new profit of $46,500. You're going to come out with retained earnings of $305,500. Our total owner's equity, remember, is our owner's capital plus our retained earnings. You add those two together, $380,500. You can always look at total owner's equity right here. It's this plus this, owner's capital plus retained earnings, total owner's equity. We're going to zigzag over to our next income statement. All of your values are the same. All of your values are the same. $240,000 from last month. Put that right there in your first block of cash flow. We're going to use last month's total assets. Remember, we're going to use last month's total assets for our bank account, subtracting our last month's cost of goods sold of $175,000. And we're going to subtract our operating expenses of $18,500. So take $555,500, subtract 175 from last month, subtract 18,500 from this month. $362,000 available cash. It's growing each time. Do you know how much cash it's growing by? It's growing by your net profit, because $315,500 plus your net profit, and you've got your available cash. So you can just do it that way, or you can actually go through all of the way I'm doing it. So go over here to your accounts receivable, $240,000 for this month's accounts receivable for revenues. Add these two together, your cash plus your accounts receivable, $362,000 plus $240,000, $602,000 total assets. Okay. Accounts payable for this month is $175,000 because we didn't pay that this month. We'll record it right there. Move on down. Total owner's equity, our total owner's capital, always going to be $75,000. Move down below that, your retained earnings. You take your last month's retained earnings plus your this month's profit, $305,500 plus $46,500, $352,000. Perfect. Add your capital plus your retained earnings together to get your total owner's equity. And that equals out to $427,000. Okay. We've got that. We'll scroll on down. Ninth month, all of these are going to be the same. $240,000 from last month. Okay. You record that right here in your first block of your cash flow. Now we're going to use our expense or our bank account from last month, which is your total assets. Okay. You're going to do $602,000 minus last month's cost of goods sold, $602,000 minus $175,000 minus 18,500 because we've got to pay off our operating expenses. You come out to $408,500. And I don't know if Tatum told you this or not, but it's, I mean, I explain it like this because you have to subtract from your total assets. You have to subtract all of these expenses, so it's easier to see that way. But another way to get this cash value right here is from last month. You had $362,000 as your available cash. Take $362,000 plus your new profit, this month's profit of $46,500, and you get the same exact value. So I just explain it like that because in the real world, obviously, you're going to take your assets and you're going to have to subtract all of these expenses. You're not going to take your last cash plus your this month's cash or your this much profit to get this much cash. So it's just easier to explain it that way. But another way to explain it is just take last month's cash balance right here, $362,000 plus this month's profit, $46,500, and you get your available cash because that's obviously what you have left over out of all of your expenses. So you add that together to get your cash. Okay. Some of you may be confused by that, but if not, just take your total assets and subtract all of your expenses to get that, or get your cash balance from last month, add this month's profit, and you'll get the same number. Accounts receivable is going to be $240,000 because that's our revenues for this month. Your total assets are going to be your cash plus your accounts receivable, $408,500 plus $240,000. $648,500. Okay. Accounts payable is going to be negative $175,000 because we have to pay off this month's cost of goods sold. Owner's capital is going to be always $75,000. Retained earnings, just look at last month's retained earnings value, $352,000 plus this month's new profit, $352,000 plus $46,500, come out with $398,500. Add your equity or your earnings plus your capital, and you're going to get your equity, which is $473,500. Okay. Our third quarter cumulative, it's going to be, I think the only thing that will be different. No, it's actually going to be the exact same, I'm pretty sure, from this month, because all of our values are the exact same. So you can just copy your second quarter cumulative down to your third quarter cumulative because all of these numbers are the exact same. Now, in a real world situation, that won't always be true because you'll have different customers and you'll have different orders, different number of orders. But for right now, we can copy our third quarter cumulative from our second quarter cumulative, which is all of this right here. So I'll just go through it now. 240,000 times 3, 720,000. $80,000 times 3 is 240,000. $80,000 times 3, 240,000. Machinery rent, 45,000. 15,000 times 3. Cost of goods sold is 175,000 times 3, 525,000. Our salary is going to be $10,000 times 3, $30,000. Advertising, $3,000 times 3. Rental, 13,000. Insurance, $1,000 times 3, $3,000. And total operating expenses, 18,500 times 3. It's going to be 55,500. Cool. Now we're going to add up all of our profits to get our cumulative profit for our third quarter. And now they're the exact same. Like I said, in a real world situation, that won't be true. So $46,500 times 3. And 139,000. Wonderful. Move on down to the fourth quarter. And like I said, you can copy your balance sheet right here. Copy this balance sheet from your ninth month into this opening balance sheet, so you don't have to scroll up and down. Okay, well, we're going to go ahead and start with the fourth quarter, 10th month. We copied our opening balance sheet. So our balance sheet from last month right here, copied all these values down here so we don't have to scroll. All of these values in the income statement and the cash flows are going to be the same because they're the exact same values again. First block of your cash flow is you're going to be your $240,000 accounts receivable from last month. Come down here, your cost of goods sold, $175,000 from last month to pay off. And now here to get our cash balance for this sheet, there's two ways of doing it. Like I mentioned, take your total assets, $648,500, because that's your cash plus your accounts receivable. Take this number, subtract your expenses, which is $175,000, subtract your $18,500, and you get, let me do the math. You're going to get $455,000. Another way of doing it is probably easier for some of you to understand is take your cash balance from last month, $408,500. Take your cash balance right here and add your profit, because that's how much is left after paying off all of these expenses. Add this profit to get $455,000. Like I said, you can do it one of two ways, whichever way you understand better. Take your bank account minus your expenses to get your cash, or take your previous cash balance plus your new profit to get your balance sheet, or to get your cash balance sheet. So either way, you get the same number. Accounts receivable is going to be $240,000 because that's how much revenue we have this month. Accounts payable is going to be $175,000 because we've got to pay off our cost of goods sold for this month. We're going to scroll down to owner's capital, $75,000, only because that's what we initially started with in our first quarter. He invested $75,000 worth. So his total owner's capital for all the months are going to be $75,000. Now, if he only invested $55,000, then that would be our numbers for all of our owner's capital would be $55,000. So it just depends on what you start with. Okay. $75,000 right there, owner's capital. Your retained earnings, take your last month's retained earnings plus this month's profit, $398,500 plus $46,500, $55,000. Add your earnings plus your owner's capital to get your total owner's equity, $520,000. Okay. You just go down the list and you just zigzag over to the next list and keep on going like that. Our 11th month, all of the values are the same. Start with, to get our cash balance over here, we put our $240,000 accounts receivable from last month in our first block. You move down here, you're going to be subtracting your last month's accounts payable, which is your $175,000 for your cost of goods sold. So you're going to subtract that this month. You're also going to subtract your operating expenses from your total assets, which I forgot to add together. $455,000 plus $240,000. $695,000 here. So this is our bank account. Our bank account is $690,000. This is the business bank account anyway. $695,000 is going to be what we have to pay off all of our expenses. So you can take $695,000 minus $175,000 minus $18,500, and you'll come out with. You're going to come out with $501,500. Or for the other people, you can add your last month's cash balance, $455,000, plus this month's profit, and you're going to come out with the exact same number. Okay. You're going to do your accounts receivable, $240,000, because that's what you had right here in this month's revenues. That's what you have to receive. Move down to your total assets, which is going to be your cash plus your accounts receivable equals your total assets. And that equals 741,500. Your accounts payable is going to be $175,000 for your cost of goods sold this month. Owner's capital, $75,000. Retained earnings, look at our last month's retained earnings, $445,000 plus this month's profit, $46,500. You get $491,500 total returned earnings. 491,500 plus $75,000 capital gives you total equity of 566,500. Okay. Ooh, that's a mouthful. Okay. We're gonna scroll down to our 12th month. All of the values are the same. You're gonna take your cash flow, your first block of your cash flow, your accounts receivable from last month, 240,000, put that right there. You've received that. You're going to go down, you're going to subtract your $175,000 as your accounts payable from your cost of goods sold last month. Put that there because you're going to be subtracting that. You're also going to be subtracting this month's operating expenses. So we're going to take our bank account. Okay, our bank account right now, or for our last month, is at 741,500. We're going to be subtracting our expenses out of this bank account. Okay, so you're going to subtract $175,000 minus 18,500, and you're going to end up with a cash of $548,000. And now for the other people, you're going to take your cash balance from last month, 501,500, plus your new profit for the next month. And you're going to come up with the new, or with the same cash balance for this month. Okay. So whichever way you do it, I mean, it's different for some people to understand because you just take your bank account and you subtract your expenses out of it to get your new cash balance, or you just take your old cash balance right here and just add your profit to it and you get the same thing. Your accounts receivable is going to be $240,000 because that's what you have to receive this month. Accounts payable is going to be $175,000. You've got to pay off cost of goods sold this month. Scroll down to owner's capital, $75,000. Retained earnings, look at last month's retained earnings, $491,500. And you're going to add this month's profit to it, this month's earnings. And you come out with $538,000. Add your earnings plus your capital to get your total owner's equity, which is $613,000. Okay. Our full year cumulative, let me see. So our full year cumulative. So now, because it doesn't say fourth quarter cumulative, this says full year. So we're going to be adding up all of these values for the whole year. Okay. So we're going to add up all of these values from the 12th month until the second month are the exact same values. Okay. So the only values that are different are this first month and this second month. So that tells us that we have 10 months of the same values. So what you can do is you can take these values, multiply them by 10, and then just add the first 2 months to them. Okay. So we're going to do $240,000 times 10 because we have 10 months of the same values on the income statement, which is 2.4 million. You're going to scroll all the way up here to get your first and second month's revenues. 180,000 right there, plus 100,000 for the first month. And you've got $2,680,000 as your full year cumulative revenues. Okay. So we took our revenues from all 12 months and we added them together. But because 10 of the months were the exact same values, we just multiplied 240,000 times 10 months and then just went up to the first and second month and added those revenues to our total. Okay. Next, we're going to do our direct materials. Again, we're going to multiply 80,000 times 10 because we have 10 months of the same value. You get 800,000 for those 10 months. Then scroll all the way up to our first month. Direct materials then was 20,000. So add 20,000 to 800,000 plus 40,000. You've got $860,000 for a full year cumulative of direct materials. 860. Direct labor, we have direct labor as the same for 10 months. $80,000 times 10 gives you $800,000. Scroll up to your first and second month. Your direct labor for them is 800,000 plus $30,000 for your first month's machine or direct labor. And you're going to add 60,000 for the second month's direct labor. $890,000. Okay. Go here, your machinery rent, $15,000 times 10, because 10 of our months are the exact same, gives you $150,000 plus $10,000 for our first month, plus $10,000 for our second month, $170,000 cumulative machine rent. All right, our cost of goods sold, $175,000 times 10, 1.7 million. Go up to your first and second month. We've got plus $60,000 and plus $110,000. Gives you $1,920,000. Okay. Our salary is going to be, and now for these operating expenses, you can just multiply each of these by 12 because our operating expenses didn't change at all, regardless of however much revenue we sold. These operating expenses all stayed the same through all 12 months. So 10,000 times 12, 120,000. 3,000 times 10 is going to give you 30,000. 4,500 times 10. Oh, what am I doing 10 for? Geez, sorry guys. $3,000 times 12 because there's 12 months and a year. $36,000. Okay. 4,500 times 12 because there's 12 months in a year. $54,000. And they didn't change for all 12 months. Insurance 1,000 times 12, and operating expenses is going to be 18,500 times 12, $222,000. Cool. And now we come down to our profit. Our profit was the same for 10 out of the 12 months because we had the same revenues for 10 out of 12 months. So 46,500 times 10, $465,000 plus your first and second month's profit, which is going to be $21,500 plus $51,500. Oops, sorry. Come down here. All right, and you want to know what's cool about your cumulative profit? is going to be that our retained earnings for our 12th month is going to be the exact same, because our retained earnings are our cumulative profits, and obviously full year cumulative profit is 538,000. Same with the retained earnings, because we add them up every month. So those are going to be the exact same values. Yep. All right, so I switched to my our break-even worksheet, and I deleted all the numbers so that we could go through and find them out ourselves. So what I like to do is start at the bottom of the break-even, because this is where all of your constant expenses are, and just work my way up from there to get our revenues, which would give our units. Okay. So our operating expenses are always going to be $18,500, as we know. Our insurance was $1,000 a month. Okay, and this is going to be calculated for the first month. So all of the values for the first month need to go, or all of these constant values need to go in here. Our office rental is $4,500, advertising $3,000, salary $10,000. We don't know our cost of goods sold, because we don't know how many units we need to produce to be able to break even. So this we're going to leave blank, because with the number of units that you make, your cost of goods sold is going to vary. So we don't know that number yet. Your machinery rent for your first month is going to be $10,000, because that was what was in our description right here. Yep. $10,000 per month. So that's constant. That does not at all vary depending on how many units you make. So that is a constant number. So that's why we put that in there. Okay, it doesn't, you always have to pay $10,000 for machinery, regardless of if you create one product or if you can't create 20 products, you know what I'm saying? So that's a constant variable. So you're going to leave that there. You're going to add all of these up. So you're going to add $10,000 plus your $18,500 for your operating expense, and you're going to get $28,500. Okay, keep that in the back of your mind, $28,500. For our first month, our unit price is $10. So you're going to scroll back up here. Unit price $10,000 or $10. Sorry, wish it was $10,000, but no, $10 per unit. Okay, your direct materials are going to be $2 per unit, and your direct labor is going to be $3 per unit. So 3 plus 2 equals 5. So that is how much cost of goods sold it takes to create one unit. Okay, so $5 per unit is the cost of goods sold for a $10 unit. Okay, so you're going to take your $5 cost of goods sold and subtract that from your $10 per unit to give you your basically what you keep, which is $5 per unit. Okay, which is going to be your profit. So 3 plus 2 equals 5 for your direct materials and your direct labor. You subtract that from your $10 per unit sale price. Okay, obviously you're left with $5. Okay, remember that number that I told you, which was the machinery rent plus your operating expenses, which is $28,500. You're going to divide that by $5. Okay, because that's how much profit you are going to keep, and you're going to end up with 5,700, right? So that's going to be your number of units that you need to produce to break even. So it's your operating expenses plus your machinery rent plus those specific expenses divided by your profit per unit. Okay, and you can look in the if you already downloaded the little document I had sent, it explains that there. So it's your expenses, your constant expenses divided by your profit per unit to get your number of units that you need to sell to break even, to pay off all of these expenses. Okay, so 5,700 units would be able to pay off those, and you'd be left with nothing. So 5,700 units times $10 sale price, you're going to get a revenue of $57,000. Now take direct materials. Remember, our direct materials were $2 per unit. So $2 times 5,700 units. It's going to be 11,400. Your direct labor is going to be $3 per unit, because we go back up here. $3 per unit.
It's Ellen Lucy.
Sorry. Okay, $3 per unit for your direct labor. So we'll go do that now. 5,700 units times $3. It's going to equal to 17,100. Now you're going to add these up to get your cost of goods sold. Okay. 11,400 plus 17,100 plus 10,000. You come out with $38,500. Okay. Now, if you take your revenues, okay, that's how much money you make off of selling 5,700 units. Take your revenues, subtract your cost of goods sold, and subtract your operating expenses, and you're left with zero profit, which is your break even. Whenever you break even, that means you don't have any profit and you don't have any loss. You break even. Okay. That's why whenever we did our expenses divided by our profit margin for our unit, that's why we got our end unit number, because it takes 5,700 units to be able to pay off all of the expenses to be able to break even. Okay, I know that can kind of be confusing, but you can try it out with different numbers in different scenarios and you'll always get the same $0, zero break even profit if you do the steps that I just told you. All right, calculate for the third month. Current assets, go up to your third month. Where are our assets located in our balance sheet? Our total assets, which is also known as our current assets because we've added them up after every single month. Your current assets are going to be your $369,500, which is your cash plus your accounts receivable. Put that right there for your current assets. Current liabilities. You go over here, check your accounts payable, which is also known as your liabilities, which is marked with this L right here. You're liable to pay $175,000, okay? Because that's your cost of goods sold from the third month that you've got to pay. You're liable to pay that. So you go down here, liabilities of $175,000. Your current ratio. This is where you take your total assets or your current assets right here, and you divide it by your liabilities. So do $369,500 divided by $175,000. You come out with a ratio of 2.1. So how I read this is for your assets are the first number and your liabilities are the last number. So I read this by, for every $2 of assets that I have $1 in liabilities, which is good because that means you're able to pay off your liabilities with your assets that you have. Now, if your front number right here, if your assets number is lower than your liabilities number, you've got a problem because then you have no money to pay off your liabilities. You've got $0 of assets for every $1 of liabilities. You're not making any money. That's your negative cash flows that we did the first week. So this means that for every $2 in assets you have $1 in liabilities, which is a good ratio. Okay. Owner's equity, go all the way up here. All right, right here, total owner's equity, $194,500. Okay, and this is all being calculated for the third month. Cost of goods sold for the third month, $175,000, right there in bold. And your gross profit margin. Okay. We didn't really go over this much, but in our third month, what we do is we just take our revenues. So our $240,000 in revenue, and we just subtract our cost of goods sold to get our gross profit margin. So gross means you haven't subtracted all of your expenses from it yet. That's why it's a gross profit margin. So you just take $240,000 in revenue and you subtract your cost of goods sold, which was obviously the money you used to produce it. $240,000 minus $175,000, and you get $65,000. Of course, you could also do it this way, which is just your profit plus your expenses, and that'll give you the same number, which is, I think, 65,000. Yep. You could just add your profit plus your expenses because that's all that you have left to pay from your gross profit margin is those numbers right there. Or you could just do $240,000, subtract 175, and you get the same thing. So whichever one you want to do. Okay, and that looks like it. If you have any questions, feel free to email me or text me. Thanks. I hope this helped.